Welcome to our webinar today. And my name is John Brenner. I'm the Executive Director of the Pennsylvania Municipal League. And we thank all of you for taking a couple of minutes just after the lunch hour for today's session. Today we welcome Wells Fargo for their presentation. For those of you that don't know, this is the League's 125th anniversary. And Wells Fargo has been fantastic this past year as our presenting sponsor to help us celebrate 125 years. So a big thank you to Wells, the entire team, for all their support of the Municipal League this past year. They're also our bank, so we've worked very closely with Wells for many, many years, and we have a wonderful and strong, positive relationship with them. So hopefully we'll learn a few things today about what's going on in the world. I know we're all working on municipal budgets, so it's that time of the year, and we're all anxiously anticipating getting healthcare numbers in for all of our organizations, whether you're a public or a private entity. So that's certainly something that's on all of our minds. But again, we want to welcome Wells. They're a business leader. We have a number of Business Leader Network members. And if you're interested in contact information for Wells or for any of our business leaders, you can visit us at pml.org, or you can talk with Jen Friel, who's on the call today. Jen is our Strategic Partnership and Program Manager, or Chris Luco, our Member Engagement Director. Chris is, as we were just talking, from the coldest place in Pennsylvania, Bradford, PA, and he's the former police chief and manager up in Bradford, so he's got great experience. And we have Bailey Rocco, our sustainability coordinator, on the call. We may have a few other staff folks, but we have a number of staff on available to you. You may need us at any time. Feel free to reach out, call, or email us here at the Municipal League. So today we're going to talk about economic uncertainty, and we're all concerned about that over the course of this past year for a variety of reasons. There are a lot of challenges making it more important than ever before for local leaders to have clear, informed perspectives about making financial and policy decisions. And so today we're very lucky to have two experts from Wells Fargo who will help us navigate this complex environment. We're going to welcome Vanessa McMichael, Managing Director at Wells, and Tim Quinlan, Managing Director and Senior Economist at Wells. Together, Vanessa and Tim are going to share some insights from Wells' economic and fixed income strategy teams, offering us some context and hopefully some guidance on where we go with our day-to-day decision-making as we look toward the end of this year and beyond. So please help me welcome Vanessa McMichael and Tim Quinlan. And Tim, we'll turn to you to get us started. Thank you both.
Okay, great. Thanks very much, John. It's a real pleasure to be here with you today. And thanks to all of you for joining. I've got some slides to share here, so I'll pop those up so that we can all kind of follow along as we make our way through it. And we'll sort of, of course, everything works perfectly in the dry run. And now I'm having a tiny bit of let me just make sure I've got this in presentation mode so that you guys see it in a nice full screen. There we go. All right, let's try it one more time, and hopefully this comes right up for us. There we go. Okay. John, I can see you. Are you seeing the slides? Okay, great. Terrific. All right, so we'll kind of begin with talking about tariffs and some of the uncertainty associated with it, and then we'll kind of look at the objectives for the Fed with its meeting coming up next week, talk a little bit about the labor market and inflation and the absence of data and the fact that we're in the midst of a government shutdown here, and try to make the best sense that we can. But arguably one of the biggest trends this year, or maybe trend isn't the right way to put it, but sort of headwinds the economic activity, is the variable environment that we've got around tariffs. So this chart on the left-hand side kind of looks at things on a year-to-date basis, just from our starting point with a 2% effective tariff rate, and to kind of where we are now with a little bit of uncertainty around which of the tariffs that have been passed are fully legal and which aren't. We've got a special report going out this afternoon talking about what we expect in the context of the Supreme Court's consideration of those tariffs. But suffice to say, we're dealing with a lot of variability in terms of where the tariff rate effectively is. Then on the right hand side, we look at the past 100 years or so, just to kind of put in historical context just how much of a change in trade policy this really is. This is our tariff tracker, where we, as the name sort of implies, keep tabs on all of the latest developments with respect to trade. So if you see a headline or an announcement about new trade policy, typically within 48 hours, sometimes within 24 hours, we'll have all of the details updated on this. But the challenge that we've got is that this has introduced a lot of uncertainty into the outlook, and for businesses trying to make purchasing decisions and long-term hiring decisions, the level of uncertainty has been as high as anything we've seen since the height of the kind of the post-COVID era. And when you look at how it's impacting economic activity, you can see some really big swings in real, meaning inflation-adjusted goods imports. In fact, this swing that we've experienced this year is even bigger than what we experienced during the pandemic and during the financial crisis. So a pretty remarkable consideration to see how that has impacted things. And at the same time, the ultimate data on the economy, like GDP, has been a little bit inconclusive. To look at the headline numbers, it looks like we kind of contracted in the first quarter and then grew at above trend rate in the second. We think it's more helpful to look at this, think of this as kind of core GDP. It backs out trade and inventories. It gives you a better sense of the underlying mood music, so to speak, for what's driving the economy. But this is also occurring against the backdrop of a trend slowing in the overall rate of hiring. And obviously, we're flying a little bit blind right now. We don't have current data. The last data that we've got here is August. The government shutdown has sort of prevented us from having access to more recent official data, although there have been some private payroll reports that are consistent with a continuation in this slowing trend for where the labor market is going. And what the chart on the right-hand side is trying to tell you is, rather than this being a sudden surge in layoffs, the red line here is kind of your layoffs, not really much of a move there at all. All of the change has kind of been on the blue line here, or the hiring rate. A way to kind of remember our view on this is it's kind of a no hire, no fire labor market at the moment, meaning firms are sort of sitting on their hands as they try to weigh the impact of tariffs on their bottom line and other things that they might be worried about. But suffice to say, we're in an environment here where the job growth is certainly slowing. And here are some of your private sector measures that I described. So this is the data processing companies that have got some kind of closer assessments on these things. And you can kind of see that through September, they're actually reporting an outright decline of 32,000 jobs. Now, I've overlaid the ADP data against the more conventional non-farm private sector job growth, just to kind of convey the fact that these don't always move in complete lockstep, but they're certainly pretty closely correlated. So the slowing there kind of gives us some reason to stay concerned about things. Job cuts announcements have been hit or miss, but it's certainly getting in consumers' heads. The expectations for income over the next year has kind of slowed to a level that we last saw kind of in the years that followed the financial crisis. So from the Fed's perspective, they think to themselves, gosh, if we've got two jobs here, maximum employment and low and stable inflation, we might be blowing it on the labor side of the mandate. Perhaps it's time for us to lower rates. But that's kind of a tricky decision, because at the same time, inflation is, there's kind of two ways of looking at this. One is, on trend, inflation has come down from where it was 3 or 4 years ago, right? So we've kind of got it pretty close to being under wraps, but where they really want to get it is down here to 2%. And we were almost there about 4 or 5 months ago, but now you can start to see, it's just starting to creep back up a little bit. This chart on the left is the Fed's preferred gauge, the PCE deflator. Here's the more widely followed consumer price index. And in both of these, what you're kind of seeing is food and energy prices and core goods driving inflation higher. That's sort of consistent with a tariff pass-through beginning to show up. We're only kind of early stages right now, but beginning to show up in the data. And that's where it gets a little bit complicated for the Fed, because the jobs slowing is certainly consistent with an expectation that they should cut, but the kind of firming in the inflation backdrop makes things a little bit more tricky. And if you look real closely, you can find some examples of tariffs in the underlying details. So for example, audio equipment, that's something we import a lot of. Same thing with photo equipment and major appliances. This is a cumulative change since March. And what you can kind of see here is that, we've got on the import side of things, we're kind of importing a bit of inflation. It's being offset by things that are generally more domestically oriented. Eggs have more to do with bird flu and the unpredictabilities of supply and demand in the farming world, but sports event admissions is sort of emblematic of a slowing in consumer services spending, which we'll talk more about here in a second. But bottom line, we think when the Fed meets next week, they're likely to lower rates by 25 basis points. That sort of is what's reflected in this first down leg here. Then we've got another cut at the December meeting, and call it 2 more cuts in the first half of next year, gets you somewhere in the neighborhood of 3.5% or so. And I think the way to think of that is not like what we experienced during the pandemic, where the Fed rushed to the zero lower bound, nor is it like what we experienced in the wake of the financial crisis, where they raced to the zero lower bound and then kind of held rates there for 5 years, or even what we experienced in the wake of the dot-com bubble burst in the early 2000s, where the Fed went all the way to a 1% low end of the range. Rather, what this is going to probably feel like is kind of a mid-1990s style, kind of mid-cycle slowdown, where the Fed, and this is, forgive me if I'm getting too inside baseball on this, but we go from a restrictive policy rate just to a neutral policy rate, but we're not rushing all the way down to accommodative, where we're trying to boost things. That's sort of the underlying background here. So what does this mean in the context of the rest of the outlook? Well, consumer spending appears to be more or less intact, but I mentioned before that there was some deterioration in services. What was I talking about there? Well, these two charts really kind of look at the same thing. It's just this one on the left zooms in a little bit on just the last 20 years. And then the chart on the right-hand side gives you a much longer time series. And the point is to basically say that this dark line represents the year-over-year change in discretionary services spending. And what you can see here is we're skating on very, very thin ice with that category. And then the point of showing you a real long time series on it is to say the only other times that this guy has broken below zero in the last 70 years or so has been during recessions. Now, to be clear, we don't think that we're in recession right now, but the fact that households are pulling back in some of these discretionary categories perhaps points to a little bit of struggling as households deal with higher goods prices and the pass-through effects of tariffs on other parts of their spending. It's also not a particularly easy time to carry a lot of debt if you're a consumer. So you can see auto loan rates here, mortgage rates are both elevated, but look at credit card rates, which are really just historically much higher than they've been at any point in the last 20 years or so. And that's kind of complicating efforts for households. When we look at the personal interest expense, and so what this is basically not mortgage interest, but your interest on any other thing that you've got, whether that's a student loan or a car payment or a credit card payment, those payments as a share of after-tax income are about as high now as they've been at any point since the height of the financial crisis. So that's a little bit of a headwind to the consumer as well. And you can see to varying degrees, households are struggling with that a little bit. Let's forget about this spike in student loan delinquencies. That has to do with some weird reporting issues and a moratorium on payments during the pandemic. But let's look instead at credit cards and auto loan delinquency rates, which, how should we put this? They remain elevated and are kind of incrementally coming down from where they were a year or so ago, but still higher than we'd like them to be consistent with a real healthy consumer. So bottom line, we look for this to kind of peter out a little bit over the next couple of years. So that's the context for the consumer. What about what's happening with business fixed investment? Here we're actually pretty upbeat. And we look for maybe a little bit of volatility in the remaining quarters of this year once that data is finally reported. But I think the way to look at it is this kind of transformational shift in the context of how businesses are spending their money. And by that, I mean, historically, more than 50 cents of every dollar spent was on equipment outlays. And you can see that's kind of transitioned now to the point where it's intellectual property that's really driving it. What do we mean when we say that? Well, it's software, research and development spending. And then if you pick within the categories of equipment, the one thing that's really growing is information processing equipment. That's also kind of computer related stuff. And these three components here give you almost all of the growth that we've seen, not just in this cycle, but really going all the way back for the last 10 years or so. Elsewhere, CapEx spending has basically been flat. These three categories alone are what's driving a lot of the growth. And so that's kind of an interesting thing to keep tabs on. I'm going to jump ahead a tiny bit here to look at this chart, because I think this is put some interesting context around it. When you look at spending in terms of what businesses are building in terms of factories, what factories are we building in the United States? This is the real story here. It's computer and electronics products facilities, which went from the smallest category of spending just 4 years ago to a category that's so large today, it's bigger than everything else combined. And you'll also probably note here that data centers are trending higher as well. So they're kind of in the number 3 or 4 spot there, but they're growing faster than anything else over the last 12 months. So this is where you're kind of seeing a lot of things going. And our guess is that this is probably going to be associated with a productivity boom in coming years. If we look, for example, at other periods of strong productivity growth, it was during the 1990s, and even more so the cycle that followed all of the tech spending that we experienced during the 1990s. So if tech spending begets higher productivity growth, we could be on a trajectory here to faster productivity in the years ahead. All right, let's do a couple of quick comments on the housing market, and then we can talk about what's happening in Pennsylvania. So the point I'm making here is a 10-year Treasury yield gives you a pretty good idea of where a 30-year mortgage rate is going to be. The problem is it's kind of gapped out, or at least it did gap out earlier in this cycle. It's kind of beginning to run its course a little bit. This just looks at the spread between those rates, or another way of putting it is the yield on a 30-year mortgage minus the yield on a 10-year Treasury. And you can see it kind of usually lives in this band between 150 and 200 basis points. What's gotten really blown out the past few years, a lot of this has to do with the fact that most of the borrowers behind mortgages were, for the most part, people that were comfortable in a existing home and didn't want to refinance. So those that were refinancing were first-time buyers or people that were compelled to move for a job situation or something. And so that kind of trend decline in the credit rating of those borrowers contributed to this widening in that spread. Now it's kind of getting a little bit closer. We're not quite back in the normal range, but we're getting there. But this kind of shows you what I'm talking about, where existing home sales are as slow now as they've been since we were really in the doldrums after the financial crisis. So what does that mean in the context of housing? Well, in short, it means that when you look at the inventory of available homes, which is what's reflected in this chart here on the right-hand side, it's usually the case that the new homes as a share of that total inventory is only about, 5 or 10% of the total inventory. These past few years, it's been north of 30%. It's come down a little bit now. It's only 26.8, but it's still elevated from a historical standpoint. As that gets back to normal, we'll probably see the mortgage rates get back to that normal range as well. So bottom line, our forecast for housing starts isn't all that dreary, even in the context of an erstwhile kind of catch-as-catch-can housing market. So we've got a little bit of an upswing here. It doesn't mean that home prices are in great shape. There's some variability around this, and we'll talk more about this on a local basis in just a second. Kind of wrapping up here, by the time you get into the start of next year, you've got the lower rates that we talked about earlier, combined with the big, beautiful Bill Act fiscal policy, essentially putting some wind in the sails of the economy. With the two of those working together, we look for growth getting back into the 2% plus sort of range throughout the course of next year. Now, let's kind of dial in a little bit on what's happening in Pennsylvania. So whereas across the country, the the GDP growth rates have been between 2.5%, 3% the past couple of years. In Pennsylvania, they've been slower than that. Last full year GDP figure coming in at 1.7%. And that's, not completely atypical. You can see the last 26 years of data on this chart. It's not unusual for Pennsylvania's economy to trail a little bit relative to the rest of the country. There are some periods where that's reversed a little bit, but on trend, that's kind of been the case. And some of that has to do with a relatively slower population growth rate and on balance, a older average age in Pennsylvania. Although, as you can see here, in 2024, at least, we had some of the fastest population growth that we've seen really since the late 80s, early 1990s in Pennsylvania. And a lot of that has to do with international migration. My guess is that by the time we've got full year 2025 data, the contribution from international migration is apt to fade a little bit. And I recognize there's some politically charged context around that. But the point is to say, at the moment, there's still there's some positives coming from that population growth. Now we can talk about the participation rate, which is kind of your share of working age adults that are participating in the labor force. And across the country, there's been a trend decline in that. And that has been, Pennsylvania has not been any exception to that change. It's not to say that there's not job growth. There certainly is. When you look at the job growth by metro area across the Keystone State, you can see State College, Lebanon, Williamsport, all growing at slightly above trend. And some of the bigger population centers growing something closer to trend. But even in the slowest growing markets, this is still positive. That's a good thing. There are many states around the country where when you look at the growth by metro area, there are some that are posting sharp declines. And as you saw earlier in the private ADP payroll data across the country, there are some declines. So it is encouraging to see that this is positive population growth across the board. And when you look at unemployment rates across the state, they're either at or slightly below national average for unemployment. So that also speaks of a relatively healthy labor market. So we talked about where the job growth is coming from by metro region, where is it coming from in the context of various industries. And now here you will see a little bit of declines, and I think it can make you feel better about the declines in just a second, but let's kind of take a quick look here. So healthcare and social assistance, educational services, leisure and hospitality, that's what's leading payroll growth across the state. And that's very consistent with what you see in the across the rest of the country. You've already probably gotten ahead of me now and see information and utilities, basically tech and utilities contributing to some of the downdraft. And here's how I can make you feel better about it. If you look at manufacturing employment across the country and across Pennsylvania, manufacturing as a share of total employment is in a long-term secular decline. Okay, then don't shoot the messenger on that. I don't think anybody's really shocked by it. The interesting thing, though, is that Pennsylvania's manufacturing exports have been in a trend ascent over the same period, really kind of kicking into a much faster gear these last 3 or 4 years or so. And that's a relatively encouraging development. And when we talk about tech employment, this is how I can kind of make you feel better about the earlier slide. Yes, across the state as a whole, it's down incrementally, but look how much tech employment has driven the overall hiring trends across the state's biggest metro centers. So both in Philadelphia, where we've added, call it 20,000 or so jobs, or in Pittsburgh, where it's more like 7,000 or 8,000. But in both instances, this sector has driven pretty fast payroll gains in both of these cities. So the fact that we're giving up a little bit of ground here, and yes, on a year ago basis, it's down incrementally, but relative to pre-pandemic levels, it's still sharply higher. So I think that's kind of the way to think about it. So that's kind of the highlight reel in terms of what we're seeing when we think about the broader economy and Pennsylvania's role in it. It's one thing to talk about the the economy and the outlook for rates. It's another idea to have some ideas about what to do about that. And that's where my partner, Vanessa McMichael, comes in. She's got a daily newsletter that she puts out every day and follows the inner workings of credit markets and has a lot more to say about what to do about some of these things than me just kind of describing the misery here. So with that, Vanessa, I will pass it over to you.
Thank you so much for that, Tim. Gloria, really quickly before I head off to or start my session, do you have a question for Tim? Is that why you answered your question? Raise your hand. Sorry.
Yeah, real quick, and just confirming. So you just talked about the growth in tech, right? And that slide coincides with an earlier slide where you talked about businesses investing more, right? And reporting and resources that go along with data visibility. Am I thinking about that correctly? Like, am I tying those two together accurately?
Yes. Yep, absolutely.
Okay. And then the other question is, and you may have said it when you mentioned this, Fed cutting rates. Do we have an estimate, a guesstimate? What do we think by how much? And I apologize if you said it and I missed it.
No, that's okay. Basically, in 25 basis point increments or a quarter of a percentage point increments, we think that the Fed has about a full percentage point to go in terms of lowering rates. And that'll be a little bit front loaded. So we get the first step of that in October. There's one more Fed meeting before the end of the year in December, and we're kind of a little iffy on that call, but we think that it's likely that they'll still deliver on a rate cut there. The trick, Gloria, is it depends on how things evolve in the context of both inflation and employment. Now, on Friday of this week, we'll get the very last CPI report before the shutdown. The Bureau of Labor Statistics made an announcement about 10 days ago saying that they will go ahead and publish their next CPI release, since they had done most of the collection before the government shutdown took place. But the longer this shutdown drags on, it does introduce a little bit of extra volatility, or kind of clouds the lenses a little bit, because we don't exactly know what the inflation data look like in the interim. So forecasting what the Fed is going to do is a fraught exercise at the best of times. But when we don't know what the underlying data look like, it gets a little bit tougher to gauge. Now, let's say we reopen the government in the next few weeks and we get a clear idea of what the data looks like by December. If at that point job growth is in no better shape than it is now and inflation is not going through the roof, then yes, the Fed is likely to deliver on another rate cut. If, on the other hand, there's a sharp market rebound, and that labor market rebound, and that wouldn't be consistent with what we're seeing in the private sector data, but were that to be the case in the official jobs report, and let's say, for the sake of argument, that inflation data were to pick up sharply, that would maybe make us a little bit more hesitant on the trajectory of rate cuts. In other words, we think that they might be one and done here at the October meeting and take off in December. But if things kind of go more or less on trend with what we've seen in the last 6 months or so, which is to say a broad deterioration in the labor market and an only incremental rise in the inflation backdrop, then all else equal, our bet is they take rates a full percentage point lower between now and, say, June of next year.
Fair enough. Thank you for that. I appreciate it. Yeah.
Sure.
Awesome. Thank you, Tim. And that is a fan. We weren't going to take questions to the end, Gloria, but I was hoping you had a question that would be such a nice transition. And it was a great transition, because now we're going to talk about.
Dialing in late. I apologize.
Well, now we're going to transition and talk about fixed income markets. And this conversation, and let me now share my slides. So the conversation around, Wells Fargo's house view, which is what Tim provided. I call it the house view. Our economics team, they're the ones that actually put pen to paper when it comes to rate forecast on behalf of the institution, and that is quite a job. So hats off to them for being able to put pen to paper on numbers on a monthly basis during this very uncertain time. While it's a really current kind of debate in fixed income markets, what's the Fed going to do next week? I mean, the market is expecting for the Fed to cut again. We here at Wells Fargo, our economists are, even as strategists, I am as well. Sometimes we have differing views as economists and strategists, which is okay. But for all the institutions on this call today that have cash that you can invest in fixed income markets, I don't think it's beneficial for us at this stage in the cycle to get caught up in, is the Fed going to cut 25 and then 25 again in December? Are they going to cut 25 and then pause and then when's the next 25? I just don't think it's very beneficial for us at this stage to kind of get caught up in that game, right? I have air quotes. I know this is being recorded and anyone listening to the recording can't see my air quotes, but I'm using that word game in kind of an air quotes manner because that's kind of what it becomes, right? It's something that we as fixed income professionals like to debate amongst each other. But for anyone, for any public organization managing cash, I want to talk about how I think we should be thinking about this rate environment and where we can allocate cash in fixed income markets. Before I dive into my slides, though, I am titling my section "Along for the Ride Using What We Know," and I want to highlight this title because it really does summarize what I think, or what I hope, is going to be the biggest takeaway whenever I finish my remarks. This has been a very volatile year. I've been in this role for about a decade and a half, and there's always intermittent volatility that moves markets and can kind of change the way investors are thinking about allocating cash in fixed income markets. But this year, the volatility and the uncertainty has just been consistent. So before I dive into the slide, something else I just want to highlight to this audience. So I'm a fixed income strategist. I sit on the trading floor, so I do apologize for any background noise if any of that happens during this call. But in my role, every bank that you interact with is going to have a variety of strategy teams. You have your currency strategist, your rate strategist, macro strategist, et cetera. My team is different in that we don't focus on a particular part of the market. We focus on the end clients. So institutions like you all that are on this call. So my group, we're called Corporate and Public Entity Strategy, and we work with cash managers, treasury professionals, where you're managing cash for your organization, and you may have opportunities to invest that cash in the markets to help enhance your safety and liquidity goals. So with all that in my seat, I spend a lot of my time with clients working through education on markets, just kind of talking about dynamics, with public clients, looking at state laws, which tell us what we can and cannot invest in, and then trying to match our cash flow cycles and expectations for our cash with the instruments that we're allowed to invest in. So I wanted to start the conversation that way, just so you can understand the discussion that I'm about to have with you is probably not your just typical fixed income strategy conversation, right? We're gonna talk about safety and liquidity and how to use fixed income markets to enhance those sort of goals, because those are our priority goals if we are investing. Okay, so now let's kick off the conversation. So talking about trends so far this year, and these investor trends are trends and discussions that I'm having with clients like yourselves throughout the year, and there are kind of two parts to this slide. Well, really three parts. On the very right-hand side, what you see there are kind of 5 concerns listed. And so this is a survey conducted by the Richmond Federal Reserve on a quarterly basis. And every quarter they ask CFOs, what's keeping you up at night? And so I've pulled out the top 5 concerns from this survey in the second quarter of this year, which is the very top. So you see trade and tariffs number 1, uncertainties number 2, followed by monetary policy, demand, sales, and revenue. This is a more of a corporate CFO type of survey, and then the health of the economy. And so I want to focus on this before we move to how some of this has changed in the third quarter for the same survey. I'm highlighting in bold that word uncertainty. So this is a survey that the Richmond Fed has conducted for decades, right? It's not new, but this was the first time through the life of this survey where the word uncertainty, that word by itself, was a top 5 concern for CFOs. So not even during the great financial crisis did this word come up in this way, not during COVID, but at the beginning of this year, given all of the headlines that were circulating, every day we would kind of all walk in and there would be a new tweet, right, or a new message from someone delivered on TV that was a headline and not necessarily a data point that was moving the market and shifting concerns for financial professionals and really causing a pretty significant change in the way that our investors were thinking about investing their cash. And so because of this, because uncertainty was so heightened on kind of like the left hand side of the top part of the slide, there were two paths for conversations that I was having with clients. Again, either those corporate or public entity clients, and we lump them here together or talk to them together because these clients, whether you're a corporate organization or a public organization, safety and liquidity goals are foundational, right? And so we really are investing in kind of the same group of instruments in fixed income markets. But for this client base, there were two paths for conversations at the very start of this year. So at the end of last year, the Fed cut 100 basis points over the final 3 meetings of the year, and there was a shift in the yield curve, and we saw some clients extending maturities on their investments because the belly of the curve, kind of that 2 to 5 year part of the curve, rates rose at the end of last year. And we come into 2025, and there's just massive uncertainty. And so one of the most striking trends that was very apparent immediately when this year started was this focus on liquidity. So no matter if it was a corporate organization or a public organization, there was so much uncertainty, it was causing us to want to maintain access to our cash. And then on the other side, because there were so many headlines circulating and causing pretty significant movements in markets, there were a number of clients where liquidity was still the focus, but there were days where we would come in and rates would pop higher because of a headline. And we saw clients stepping into the market then at that point and grabbing, longer maturity securities. As an example, I'll use the 2 year, which we are going to talk about on the next page. But the 2 year is one where it oscillated kind of right above and below 4% early this year. And so on volatile days, when that 2 year would climb above 2% because of a headline, we would see more engagement with clients where liquidity was still really important, but wanting to grab that 4% yield. And I highlight this too, because for this audience, one of the things John mentioned at the very start of this conversation was that it's budget season. And there are certainly some things that public organizations can do with their cash today to help create at least a couple of line items of stability within different various budget seasons. But for the same slide, if we transition to the third quarter of this year, so same idea on the right-hand side, the top 5 most pressing concerns for CFOs, you see that word uncertainty gone. So the uncertainty started to fade just a little bit. It was still there, but here are all the other concerns that were at least the top most 5 pressing concerns through the third quarter of this year. And when I think about the conversations I was having with clients during this period, liquidity was still really important, but what I did see or what I did hear from clients at an increasing rate was a desire to invest in safe securities. Now, safety is part of our required goals, but there was a strong emphasis on safety. So a desire to want to invest in government securities. If we were investing in credit, to really stick to the most high quality credit that our investment parameters allowed us to invest in. And then towards the end of the third quarter, kind of in that August-September timeframe, one conversation that stuck out to me, and it's interesting because we knew the Fed has easing. The Fed has been easing. But when the Fed cut again, or was getting ready to cut again in September, suddenly organizations that were sitting in cash alternatives were seeing 3% rates for their cash alternatives. And it seemed to be a bit of a shock, even though we were expecting it. We've been talking about this. It's going to happen at some point if the Fed continues to cut. It really seemed to shock clients. And so the conversation around trying to figure out within our investment parameters what other asset classes we could use while keeping liquidity and safety in mind to see if we can capture 4% rates, that has been a really recurring conversation. So this next slide, this is what you're looking at on this slide. This is the 2-year Treasury note yield. At least that's the line going through my chart. And I focus on the 2-year a lot in my seat for a number of reasons. Firstly, it is across the Treasury curve, the most sensitive tenor to expectations about the Fed's policy rate. So not the actual change in the Fed's policy rate. The front end of the curve is impacted by those sort of changes, but these are just expectations, right? And expectations throughout this year have been very volatile, right? At the beginning of the year, we were expecting 6 cuts or maybe 4 cuts and then 2 cuts. And now we're at the end of the year. And the larger market assumption is that the Fed will ultimately end up cutting 3 times this year. So again, next week, and then one more time in December. Regardless of the fact, though, that the Fed did not began cutting its policy rate again this year until September, you saw all this volatility in the 2-year because of these headlines, right? Because of expectations. And it really has only been the past few months where the data seems to really matter again. So Tim talked to us about, this dynamic with the labor market data and it's softening, but then we have inflation on the other hand, beginning to creep higher, but it was really the labor market data and the deterioration there. And what history has taught us about the deterioration in labor market statistic in labor market data is that it can ultimately lead to a recession. And so that became a really significant concern for the market. It became a significant concern for the Fed as well, because they did cut. And if you listen to what the Fed is saying before, their FOMC meetings, at least over the past few months, they are all paying a lot of more attention to the labor side of their dual mandate than the inflation side, because there is some real concern there. So for investors, and this is where I want to talk a little bit about why I don't think it is so beneficial for public investors to get caught up in the cadence of continued Fed fund cuts or the magnitude of them. It's the yield curve. We're gonna focus on what happens in the front end of this yield curve. So this is the yield curve out to 5 years at 3 different points in time. So October 2024, so where we were around this time last year, is the very top line, that dark solid blue line in my chart. The gray line is the same curve when we pulled data earlier this week, and then the red dash line is where the market thinks the curve is going to end up a year from now, so October-ish 2026. And what I want to highlight here, a couple things on the left-hand side. So, the era of 5% rates was really nice, particularly for public investors, where safety and liquidity were the priority goals, where we were probably using a lot of cash instruments. What do I mean by that? I mean funds. Maybe one of the local government investment pools in Pennsylvania, maybe some government money market funds, maybe some bank deposits. But that's where the highest rates were, because the curve was so inverted and the Fed had hiked pretty aggressively. And then throughout this year, 4% rates became like a new benchmark for clients. So I don't love using the word benchmark with public investors, because if we're trying to obtain safety and liquidity goals at the same time, intermixing a benchmark can create some conflict with those sort of goals. But nonetheless, 4%, 5% was a benchmark or a level that investors were expected to obtain. This year, 4% was that level. Now I think the new expectation needs to be somewhere around 3.5%, because here's the reason. So regardless if the Fed cuts another 25 basis points this year, 50 basis points, or 100 basis points over the next 12 months, we know that the Fed still has to cut quite a bit to get to its neutral rate, which is the rate where the economy is neither growing or contracting. That's their ultimate goal at some point, to get to this neutral rate. And so we're a little more than halfway through this cycle, and we still have 100 basis points more to go for that neutral rate. If you look at how the shape of this curve has adjusted since the Fed started its cutting cycle, you see almost a complete collapse in the front end of the curve, right? We were looking at 5% rates on the front end. Now we're about 4%. We're going to be really close to 3.5% soon, and we ultimately are going to get to about 3% on the very front end of the curve. But if you look at the belly of the curve, and I define the belly as kind of that 2-year to 5-year part of the curve, there's very little movement there. So obviously there was some movement lower over the past year, but if you look at where the curve is today, so that gray line versus the red dash line, very little movement there. And so from a budget perspective, if we are heavily invested in cash instruments, that is where we're going to see the greatest deterioration in yield. And ultimately, that's going to lead to the greatest deterioration in interest income that we would receive on fixed income, or we would earn on fixed income investments. And for public investors in particular, I think if we have the ability to make every dollar work for our organization, then we should be thinking about that. And so right now is still a really good time to, if organizations have the cash to invest, I think, to begin to move some of that cash out of these cash instruments and put it out a little longer on the curve. And what that does, and you're putting it in safe instruments, right? Government instruments, or a lot of public entity organizations are using when they are extending their investments out on the curve. But what this does is it creates at least a portion of consistent income within, a portion of your budget. And I think that matters, because we have seen in the past, depending on how this cycle evolves, the front end of the curve can fall pretty quickly if the Fed decides that it really needs to step in to rescue the labor market in the immediate near term. I think I'm gonna skip over this slide, just or maybe I'll just quickly talk. I kind of already mentioned that we've heard from Fed speakers over the past few months that there's a pretty significant focus on the labor market and trying to limit more downside. And so that's why the Fed had cut in September. That's why the market is expecting, we here at Wells Fargo are expecting the Fed to continue to cut next week at its October meeting. But to Tim's point, the debate about that December cut is picking up because it seems to be driven mostly because of this of the cloudiness and the uncertainty in the data, because the Fed is so data dependent with these decisions, but our government is shut down, and so that's creating some challenges for the Fed and at least its near-term path. I'm going to skip over this slide. This just kind of talks about Fed expectations. I want to spend at least most of the rest of the time that I have with you all on this discussion around safety, liquidity, and yield, because this is the foundation for every single investment decision that we make as a public organization. And so we know what these terms mean. One thing I like to discuss with clients is what these terms don't mean. So from a safety perspective, safety does not mean that we are avoiding investing in fixed income markets or that we are overly concentrated. So I think even if we have most of our cash sitting in some sort of pooled fund, given the dynamic I just showed you all with the front end of the curve, so from a safety perspective, that may check the box. From a liquidity perspective, that may check the box. But when we over concentrate, you do expose yourself to, even in a pool, one part of the market. And obviously that's the part of the market that is going to be impacted the most as the Fed continues its path to neutral. From a liquidity perspective, liquidity changes. And so one thing that I am hearing from public investors in particular are funding concerns. And so what I mean by this, so this year, out of all the years that I've been in this role, I've heard more public organizations share concerns about maybe not receiving certain funding that they were expecting for a variety of reasons. And so what does that do? It's causing investors to want to remain a little bit more liquid if they can, because we don't know if we're going to have the funding. And so we just need to have access to our cash. And so this, in this environment, is a really good environment. Is just to remember that liquidity can change. And I want to talk a little bit about how to enhance liquidity by using other instruments in a couple of slides. And then lastly, when it comes to yield, this is always part of our stated goals. It tends to be the last of the stated goals because safety and liquidity are the topmost priorities for every investment decision that we're making. But yield was a really significant driver for conversations in 2023 and 2024 because of Fed policy and because of what Fed policy was doing to the front end of the curve. So let's talk about how I'm discussing with clients, how to think about this safety, liquidity, yield dynamic right now. When I think about safety, and one of the things I said on my prior slide is that safety does not mean over concentration. And so one of the best ways that I've seen clients or investors think about safety from this perspective is to create segmentation in their portfolio. And public organizations are really good at this segmentation piece of investing because we typically have very defined pools of cash for very defined services, right? So we kind of have like this natural cash segmentation, but what this segmentation does is it creates characteristics that are going to define which instruments are going to be appropriate for that specific pool of cash. So if you look at the slide, something like a liquidity buckets, this is like the cash you have for operating uses. I mean, this is same day liquid stuff. This is where it makes the most sense to invest in the pools, maybe we're using bank deposits here as well. And I do see some clients use short government instruments in this bucket, but most of the time we are thinking about those sort of pooled funds, your local government investment pool, your government money market funds. And that's because this fund, this bucket of cash needs to be same day liquid we don't have capacity to take on any sort of price volatility. So we just need to make sure it's there when we need it. On the other side, for anything that's not a liquid bucket, so these would be like those other pools of cash that are set up for, you know, specific services. They can be more strategic. And so because they are pools of cash that we may not need readable access to, this is where I see clients add different asset classes, maybe some government instruments, maybe some credit instruments if we're allowed. But this is where we can take on a little bit more volatility. And what I mean by this, I mean price volatility. And it's not that we're trying to intentionally invest in securities that are more risky, but the reality is because of the way that bonds are priced, the longer the maturity of a security, the more day-to-day price movement there's going to be if you sell a security. Now, for a buy and hold investor, which pretty much every public organization I work with is a buy and hold investor, those day-to-day movements don't impact us unless we sell something. And so this is where we start to talk a little bit about using fixed income markets to enhance our liquidity. So 3 strategies here. The first one is pretty straightforward. That's our liquidity bucket. So just thinking about diversifying those instruments. But 2 and 3, and the second strategy on here is one that I see public organizations implement the most. It's a bond ladder. So the idea here is that, and this helps satisfy different pools and buckets of cash as well, or segments of cash. But the idea here is that, you know, every 2 weeks, every month, every quarter, we have a security maturing. And so what that creates is it creates ongoing liquidity depending on how often the maturities in your ladder are set up. What I really like about this strategy is it really takes that, in the beginning of this conversation, I was using the word game in quotes when it comes to thinking about, you know, is the Fed going to cut 25 or 50 or 75 or whatever it is, the debate that we as, you know, fixed income professionals get wrapped up in every single day. I don't think that's necessary for organizations on the phone. But because when you're setting up this sort of bond ladder, you're always investing when you're making that investment decision in whatever the highest prevailing rate is at that time. So you don't necessarily have to think about is now the right time to invest out 30 days or to invest out 45 days, or again, whatever the consistency of your ladder is, because you're just consistently kind of rinsing and repeating and placing a security there so that you have cash coming back to you at that predetermined end date. Now, with this sort of strategy, there are particular instruments in fixed income markets that I see used, particularly for shorter ladders, kind of like a year and in. So maybe a client has, you know, a final maturity of their ladder is a year, but then from today through that year, maybe they have maturities every 2 weeks or every month or whatever it is. Discount instruments are really helpful cash management tools. So what is a discount instruments? Things like treasury bills, things like agency discount notes. So instruments that where we are lending money to other U.S. government organizations on a short-term basis, and when we lend them the money today, we don't get an interest payment between now and maturity. We kind of get all of our cash at that maturity date. So if it's 30 days, we get all of the cash that we earn in 30 days. We don't have to deal with an intermittent coupon payment, and I think that's really beneficial for something like this ladder. The other strategy that we do see some public entity organizations implement, and this one can be really helpful for, you know, when we were looking at the curve kind of 1 month to 5 months, and I showed how the front end is expected to continue to drop, at least rates, and the belly of the curve is going to be pretty stable. And so if it's not always the easiest decision today to say, you know what, I have this sum of cash today. I think I don't need it for 2 years, but like there could be some reason why I don't. And maybe I'm a little, a little bit more nervous about actually investing it out 2 years. One way to create that structure with longer maturities in a portfolio is to invest based on future known cash outlays, right? So maybe there's some like debt service payment that we have to pay at some point in the future. We can invest today, the cash that we have, the excess cash, in a security that can mature right prior to that payment, or whatever other large known outflow we have in the future. It matures, and then we pay off that security. So that's one way to enhance our liquidity and also build in some structure and take advantage of what's going on across the belly of the curve. And then lastly, yield. It's kind of the final consideration with our investment goals, but I think it matters a lot for public organizations. And why? Because I think public organizations should be trying to make every dollar work for them if we can. In this environment where I'm hearing about these funding gaps, right, or concerned for funding gaps that I just haven't heard as often. It really any other annual period that I've been sitting in this seat, but this year it's heightened. And so I think this is one way where if we do have that excess cash, and you can see my little table there in the middle, and I'm highlighting 3% and 5% rates just to show you what the annual income could look like on some designated amount of cash, whether it's $1 million or $5 million, right? 30,000 or 150,000 extra dollars could be beneficial during a period like we are in today, where there are these sort of funding concerns. And I only have a few minutes left, so a couple other points that I want to highlight for everyone on the call. So this slide, and this is a very fixed income-y slide, right? There's all types of lines and shading going on this slide. What are we looking at here? So we are looking at a 20-year period, so May 2005 through, well, actually this was, I know it says May, but this data actually goes through October. So nonetheless, 20-year period. A few different things we're looking at here. The black line is the federal funds rate. The red line is the two-year Treasury note yield, and that gray line is a government money market fund, which you can also, I mean, it's going to be very similar to any of the like local government investment pool rates as well. It's just for me as a fixed income strategist, it's easier for me to pull the government money market fund data. And then the blue shaded area is the spread between the government money market fund and the two-year Treasury notes. And so there are a couple of takeaways from this slide. If you look all the way to the right-hand side of my chart, you see that shaded area, so the spread between a government money market, or just let's just call it a government fund, in the two-year Treasury note, it's negative. And it's been negative for quite some time. This dynamic has created sort of like a crutch for many organizations that are not extending maturities on investments or cash that they can invest. Because why would I invest in something today a little longer that has a lower rate than just kind of sitting in a cash option? And for a while, this was a tough argument, particularly when cash rates were above 5%, right? And rates across the belly of the curve were not. But we're getting to this point where, as I showed you slides ago, the dynamic on the front end and that collapse, it's nearing. And we're seeing that kind of here in the spread tightening as well, because the spread has gotten smaller as time has transitioned, as the Fed has started easing, because the front end has fallen, and that belly has been pretty stable, at least where that 2-year is. And so that's kind of one takeaway. This has been a hard dynamic to contend with. But if we look historically at this graph, typically you see a positive spread there, but that my blue shaded area. And what this means is that most of the time the 2-year is yielding more than whatever the government pooled fund rate is. And we're getting back to that dynamic as the Fed continues to ease, over the next year or so. And so for organizations that are not beginning to think about how to mitigate this in the future, we've seen this happen before, where rates on the front end fall, and then we're just missing out on that income that we could have earned. So I do think this is a really relevant conversation, particularly today, in the environment that we are in. And this slide says more of the same. I mean, maybe the one takeaway that I didn't include on the prior slide that is worth highlighting is if you look at this table in the middle of my slide. So I'm showing you the current 2-year Treasury note yield and the 5-year Treasury note yield, and then 10-year and 20-year averages. And so the takeaway is that we are still at really historically high rates. I mean, a 3.6% 2-year, 3.7% 5-year. These are rates that over the past 20 years are just not very common. And so I think that's another argument as to why I think public investors should be considering extending maturities on some of their cash that they can invest today. And lastly, and I'm gonna go through this really quickly because I'm talking way too much and we're about to be done with the call. So clients always like to know what other clients are investing in, and so that's what I'm showing you here. Now this isn't specific just to Pennsylvania, but I am going to discuss what we are seeing with some of the Pennsylvania investors or public organizations that invest with us. There are a lot of colors on this slide. So you're looking at investments from October 2024 through the end of September 2025. At the top, the only difference between these two charts is the top we include money market funds, and that's a lot of government money market funds because we don't sell local government investment pools here at Wells Fargo, right? No broker really does. That's a different vehicle. In the bottom chart, I'm removing those funds because they are a pretty significant amount of the new purchases that we do see on the monthly basis from this client type. But the one thing I want to highlight is there are a lot of colors here. So Wells Fargo, we have a very colorful template, but there are a lot of colors because most public organizations are not using just one instrument. Every color on here represents a different asset class. Now there are some pretty dominant asset classes. So if we look at just the individual instruments purchased on that bottom chart, there's a lot of gray. Those are treasuries, and a lot of those are treasury bills. In Pennsylvania, we do see more engagement with government money market funds and treasury bills versus the rest of the products that I'm showing here for other public organizations across the U.S. There's a lot of green in this chart as well because we do see other public organizations in other states investing in CP. We really don't see that a lot in Pennsylvania. What we do see in Pennsylvania is a lot of that gray. So if I were to recreate this chart just for organizations in Pennsylvania that we invest with, you really wouldn't see too much of that green. You would see some of that red though. So those are agency discount notes. That's another instrument that we do see Pennsylvania organizations invest in. And then maybe with that, I'll just, if there are just a couple takeaways I want to leave you all with out of everything that I shared. There are two. So when we think about the goals for public investors, it's safety, liquidity, and yield. These drive every single decision that we're going to make with our cash if we're thinking about investing in fixed income markets. And so in order to accomplish all three of these goals, we really should be thinking about actively investing. And actively investing doesn't have to be daily investing. Actively, we have some organizations that invest once a month. That's still active though, because they are investing in different instruments and creating some structure in their portfolio. One thing that the funds are doing, and this is what makes them so attractive in a declining rate environment, is funds are implementing that bond ladder. The bond ladder strategy I talked about, that number 2 strategy on that slide a few slides ago. If you look at holdings for your pools or your money market funds, that's what they do. And so in a declining rate environment, while they have some parts of their portfolio where that rate is falling with the federal funds rate, other parts of their portfolio are still remain invested in those higher rates. And so that's why the aggregate yield for these pools falls at a slower rate than other individual market instruments in a lower rate environment. And I think that public organizations can create that dynamic in-house themselves just by implementing a ladder. And then my second takeaway is there's been a lot of focus on liquidity. I don't think that's going away. And so I do think it is beneficial to think about not only that bond ladder, but that maturity matching strategy where we have those known cash outflows, whether it's 90 days from now, 180 days from now, 5 years from now. If we do have some excess cash, rates are still historically high, particularly across the belly of the curve. And so I think that it could be beneficial to just consider using some of those strategies to enhance our liquidity and not necessarily, add more risk to our liquidity.
I would like to take a moment and thank all of our members for joining us today and supporting the league and the time that you give to your municipality to learn, do a better job with your community. Also like to thank Wells Fargo, Vanessa, Tim, Gloria for being part of our organization and presenting this information very timely for us in the local government world right now. So with that, again, thank you all. Go ahead, Vanessa.
Chris, sorry, really quickly, I wanted to mention to everyone on this call. So Tim's group, they have a public facing website. So he talked about some report they're about to release this afternoon. If any of that is interesting to you, I'll go to wellsfargo.com/economics. It's publicly available. My team also has a website if you are interested in fixed income commentary. But just wanted to make sure that everyone knows that there are resources after this call for everything that we talked about today.
Vanessa, can you pop that in the chat real quick, yeah, just so that people have it?
Sure.
Well, everyone, again, thank you all for taking the time. Thank you, Gloria and your team. It's been great. If anybody has any questions, feel free to email. We can get them to the right people, and we will make the video available to you for about the next 30 days. Thank you, everyone.
Thanks, guys. Thanks, Vanessa. Great job.